In this video, we're going to talk about analyzing profit. Couple of things that we need to keep in mind, right, is number one is we have to worry about non-cash items, right? Those will certainly have an impact on our actual ability to pay. So cash flow is very, very important to us. Some of these ratios will have a cash flow alternative or a ratio that looks similar, except instead of using maybe operating profit, for instance, EBIT, maybe it uses a cash flow number instead of the profit number. And of course, we always want to be thinking about controlling expenses, especially with these items on an income statement. So let's look at the sets of ratios. Gross profit margin measures our ability to control production expenses. Just gross profit divided by sales. All of these line items, by the way, come right off of the common size income statement. Operating profit margin, how well do we control the expenses of actually running the company? EBIT divided by sales gives us again, a bottom line type of number excluding taxes, which makes it a very good number to make comparisons to industries, etc. And of course, the net profit margin, that's just net income from recurring operations divided by sales. So let's kind of look at how the company's performing. Here's production and operations. So as you can see here, gross profit margin for Disney is much higher than it is for the industry. So they're doing a much better job. Now, they've had a downturn this last year, but remember, we think they bought something here, so that could be that reason. So again, we want to, hopefully, in the next couple of years, this bounces back up. Operating profit margin, again, you can see that Disney has a substantial gain or benefit to that of the industry itself. So with respect to running the company, Disney has a very good sense and control of the expenses of actually running the company. So if we look at the next set of ratios, and these are the bottom line numbers, again, you can see that here's EBT divided by sales. This is Disney, and the industry is this orange one. Again, I don't know what happened this year in the industry, but you can see that in general, except that year, Disney has far higher profitability, bottom line sense than what the industry does. And if you look at net profit margin, you can see that it's pretty close to the same type of shape as EBT. So taxes really, other than lowering the number, really doesn't do much to alter the state, if you will, of the shape of the curve itself. They're pretty similar. Now, the next set of ratios that we can think about are profit ratios, but these are profit ratios that are related to the balance sheet. And again, we have three basic ones that we can make comparisons to the industry, and we also have one that we cannot. So let's first start with basic earning power and return on assets. And if you look at these two ratios, they're very similar, right? Profitability divided by total assets. The challenge with ROA is that it incorporates taxes and financing. So it muddies up the profitability of the company and their ability to create profits on assets by using non-operating line items. Basic earning power is probably one of the most powerful performance measures to measure how profits are generated using all of the assets of the company. It's just a much better number to make comparisons because, as you note, it takes out taxes and financing. So a better number, relative speaking. ROE is return on equity, and really the difference, the reason there's a difference here is because on the industry side, we don't use taxes, so it's EBT. That's why it's in quotes here, ROE in quotes. But again, what kind of profit is created using the income, the investment that comes from shareholders? So again, here we go. Here's basic earning power and return on assets. So as you can see, basic earning power is the blue, and with the exception of 1 year, it is always higher, or very close to at least, been higher than the industry. Now this last year, something has happened. We don't know what. They bought some stuff, and basic earning power has dropped like 66%. So that's a huge drop. We really want to investigate, why is this happening? Return on assets, again, that's this company one here is the gray, and then ROA for the industry is the yellow. Again, not sure what's happened in the middle here, but you can see return on assets in general is higher for the industry with the exception of 1 year. So again, profitability wise, it appears that Disney is a more profitable company. No matter how you look at it, they produce more profits for their owners than not. So they do a pretty good job on the earnings side, on the profitability side. So here we have another ratio, earnings per share. I'm sure everybody is aware of how that is calculated. It's net income divided by outstanding shares. In this case, what we have here is the question is, what are the outstanding shares? When the company issues stock, one of two things happens to the stock that investors own. If they keep the stock, that's outstanding shares. If the stock is sold back to the company at a later date in the form of what turns out to be treasury stock, that stock is not counted here. So these are only the shares of stock that are or could be common stock for the company. Now, dilution is a question. So what happens when a company issues more stock? If they issue more stock and nothing happens other than that, earnings per share is going to go down because shares outstanding went up. Does that mean the company is doing worse? Not necessarily. So again, dilution is an issue that we have to deal with from time to time when you think about companies issuing shares, or quite frankly, companies buying shares back, is the opposite of dilution. So here we have the PE ratio. We'll talk about that here in another video. But the earnings per share is here. You can see it's relatively stable. We had a big bump in 18, but in this last turn it came down a little bit. So again, we're typically in the upper fives, lower sixes is where earnings per share tend to be for Disney. So we have one more relationship to kind of look at. So let's look at return on equity and what we refer to as the Dupont analysis. So return on equity, if you remember our formula from a slide or two ago, is net income divided by net worth or common equity. But the Dupont analysis breaks down owner equity into some parts here. Net profit margin times the total asset turnover ratio times the financial leverage multiplier will equal return on equity. So if you look at these ratios in their formula form, right, if you multiply these two things together, sales divides out, which then leaves you with net income divided by total assets, which is return on assets. So again, this product here of profitability and asset management, we have sales divides out. The next multiplication part here total assets will divide out. So now we have sales is gone, total assets gone, we have net income divided by common equity. So how does a company use this analysis? Well, how can you get more profit to your shareholders? How can you get a higher rate of return? Some of it's obvious. Increase profitability. Manage your assets more efficiently. But this last one's a little strange. It says if you want to increase the return to your owners, you have to borrow more money. You have to increase that financial leverage multiplier. And really, if you think about this, it does make a little bit of sense. It says, look, if you're going to get money, you can either get money from owners or you can get money from creditors. If you get money from creditors, the only thing you have to pay them back is interest. Right? So there is a fixed amount that you have to pay to them. Everything else that's a benefit above and beyond paying the interest all goes to the owners. That's the return that they get when you're borrowing their money. So again, if we look at a table, again, this table comes from the table that you're given in this course. Again, you can see that in general, the approximate return on equity for the industry is higher than it is for Coors. Well, why is that? Coors is more profitable. Coors has less efficiency. They make more money, but they're less efficient at running their assets. So if you look here, again, return on assets still in general pretty much higher. But then when you think about the financial leverage multiplier, the industry is a higher leverage factor, so that increases the profitability more than it does for Coors. So again, it's just a way of looking at how can we generate more profitability for our company and for our owners. So that's the end of this video. Hopefully you're having a good time. I'll see you in the next video.